And with that, welcome to today's video about the electrification trap. This title isn't from me, it's from Gemini, but I think it fits pretty well. And although this thesis is a bit older and it also already played out a bit, I will now talk about this to determine what's going on there. And to speak through this, I try to model this in math with Claude together, and I think it's just cool. We will talk through this, and I think in a week or so I will be providing you with some assets and some analysis, specific analysis about where the opportunities were and what's now going on with this. So we are going to talk about silver, and you probably think this is already old, and I mean it is. Silver already rose, the stocks where I was looking for already rose, and also the ETFs show good performance. So this is basically an old thesis, and we will just recapitulate what happened and what is happening. And we will then look next week where entries would have been good and where entries may be in the future, because I mean this isn't just a thing about 2 years or so, and I think we aren't even that late, because the market bears infinite opportunities to us, and if it isn't this thesis, then we will find another one, right? But it's just the practice of building a thesis, then bringing it to paper, recapitulating it and talking about this, and then finding assets based on that. And that's basically the practice to find real high performers. At least I think this, with, I don't know, 4 years of experience at the markets. I'm 17 years old. What can I say? I don't have as much experience as some of you guys probably. But today we will talk about silver and the thesis behind this, the demand drivers, the supply. And next week we are going to talk about some assets, and then we will and also now be open-minded. And in the end, as Warren Buffett said it, the market is a device to transfer money from the inpatient to the patient. And this is what we will do. We will wait until the prices come back, and they are already. I can tell you so much. I can tell you that. And then we will enter, and then we are also able to profit off of this thesis. And this is only a part of it. And there I also want to talk about copper and energy. But this all is interconnected. So I won't say silver is enough to look at, but this is the first step we will be doing today, right? So let's continue. So here's the silver supply from the Silver Institute website, and we see that the silver supply is stagnating but picking up slowly. We see we had a low in 2020, probably due to the corona crisis. And now we made a higher low in 2023, and since then we are rising. And this is good. Like, it's bad for the prices, but it's good for the general demand and supply dynamics to prevent running into a deficit. But we are already in a deficit, like you probably already know. And for supply, there's also one constraint we need to talk about, and that is that a lot, like 3/4, like 75% of the supply are coming out as a byproduct of zinc or of copper or of gold. And this is a problem for the general supply, because if the copper mine isn't profitable anymore, like back then they're closing the copper mine, and the silver as a byproduct isn't coming out anymore, because it isn't the main driver of the mine. There are primary silver mines. They make about 28% of the total supply. Don't take me by the number there, please. But yeah, this is a general problem, because the focus then doesn't lay on the silver, right? And this is the dynamic we need to keep in mind. So, and here we have the supply split up into the two main drivers, basically. We have recycling, a more dynamic supply source, and we have the mine production, rather stiff source. And as I wrote here, the mine production remains rather inelastic, while the past shows that recycling reacts responsive to price increase of silver. And we saw this in 2011. Recycling may start picking up, as we saw in 2011. There, after the 28 financial crisis, the silver prices rose a lot. And then also the recycling picks up, because the people thought, all right, I also want a piece of the cake. And then a lot of recycling facilities opened up to recycle old silver, and then get a piece of the pie, of course. But the mine production is different, because firstly, as I said, silver is a byproduct of zinc, copper and gold, mainly. And secondly, mines take a long time to get created, basically. For a copper mine, the average time until the mine is opened is 17 years, and that is a lot. And so we need to keep this in mind, because if they are investing now in 2026, then the copper mine will open on average in 2043. And here are also the factors affecting the supply. I hope this lighting works fine. It's just my screen and some natural lighting from out there. On the camera screen this looks fine, but yeah, we will see, and if it doesn't look good in the end, then I will change this for the next time. And here are the factors affecting the supply, and that is the mining cycle, that is the political environment, and that is the country status. So we will look at this. So in the mining cycle, we need to differentiate between an active mining expansion of the mining firms, a stable output but no expansionary approach, stagnancy, so paused investments, a declining output, so for example declining ore grades, and we have this right now. The ore grades, at least for copper, are declining, and that is a topic I will also talk about the next time also. Declining output also means mine closures and capex cuts, and then we have severe disruptions. So, for example, nationalization of a few mines. And there is actually a risk in Papua New Guinea. I hope I pronounced it the right way, but I think out of my research I got that this country actually has a risk of a nationalization because of the political environment there, although Papua New Guinea doesn't make a huge percentage of the total silver supply. So there are mines, but they only make around 0.3%, like a really marginal number. Then, yeah, here's the mining cycle. And here we have a chart of the capex cuts from 2010 to 2025. And as you can see here, we have, after the financial crisis, as I said, the silver prices rose, And then we see here that they rose until 2011 or so. Don't take me there by the word, but miners are investing because they also, of course, want a piece of the pie. This makes sense. So we will, no, actually not. We will see if this actually plays out good for silver, because we don't know where they invested and if there's even a silver byproduct. So this is the question. But as you can see here, I mean, right now it's rather stagnating, but in general we have a curve upwards. We didn't make lower lows, and this means that they are in active mining expansion, or they are at stable output but no expansionary approach. This depends on if there's maintenance costs right now in the mines and if they need to pay the money for this, or if they are spending for expansionary purposes. And I mean, expansionary purposes wouldn't be bad because silver rose and they already saw maybe the deficit coming of silver. I mean, it's for 6 years right now. So they probably saw this coming and they were investing in it to respond to the demand. This is what I want to say. Yeah, for stagnancy, I don't have a chart right now. As you can see, it's flat right now, so I will take this as stagnancy. Post investments, yeah. Then here we have the declining output or severe disruption, and this is basically also a product of declining ore grades. And this is what I brought here from Silver.com. And we see here that the silver grades have declined 36% in 10 years. And this is bad, not so good for the supply, because mine more for the same amount of supply. And this basically sets the supply under pressure. And I don't think, and this wouldn't make sense if the grades are increasing surprisingly, right? And for copper we have the same picture. The ore grades are declining fast, or not fast, but they are declining, right? So then I also have the political environment, and this is firstly the national consensus. So national consensus refers to a broad agreement on fundamental political, social, or technical issues within a country, often across party boundaries. And this basically says already why this is so important, because everyone agrees on this. And if they all agree on nationalizing mines, then they will nationalize mines. And another thing that's important here is the median voter, because he dictates what the national consensus is. The median voter theorem states that in a majority voting system with two parties, the position of the voter in the middle of the political spectrum is decisive. So, and we see this in most democracies. Parties often position themselves where the median voter is to get as much votes as possible in the elections, right? And this only makes sense because they're living off of this. They're living off of elections and stuff. But this isn't only limited to democratic systems, because although dictators could give a shit on the median voter, they cannot give a shit. Because if they are doing what they want, then they will also eventually use up their political capital in their country, because at some point the people will have enough and go on the streets. And if you shoot down the people, then you could go under economic pressure, like tariffs or something like this, like that. And this is an important thing to understand. Although a lot of countries that are producing silver are or do have officially a democratic system, right? So the national consensus is where everyone agrees on, and the median voter is who dictates the national consensus. If the national consensus doesn't align with the median voter, then the national consensus over time will change because the voter wants so. So let's move on. The country status. Well, it's again after Ray Dalio's Principles of Dealing with Changing World Order. I'm a huge fan of this book, and I mean, I read it only once, 3 months ago. I finished it 3 months ago, and I also made a video about this, about Germany. But it has some crucial parameters and general things that are interesting for us as people that want to understand how secure the supply is out of a given country, right? And these are geological prerequisites. So if there actually is silver or copper, then competitiveness. So do the miners actually want to build there, or isn't this unprofitable for them? Then there's rule of law, because they don't want to lose their mines just because just because there are no laws and the people are, I don't know, steal the mines. Let's say this. And there's the 10-year estimate of power. And I think that the 10-year estimate of power is the most important one of these, because it shows us if the country is in a decline or in an increasing position. And right now, nearly every country of the silver producing, of the top 20 silver producing countries are in a positive rate of power. But if this turns, then they will show a worse stability, and so they aren't as secure anymore to invest for miners, and the supply out of these countries isn't as secure anymore. Because if they are declining, this has dynamics that cause this decline. So for example, if country X is declining, this isn't because they just want it so right now. No, it's because they have social problems. They are lacking competitiveness. They're lacking rule of law, or even geological prerequisites. Although this is a not primary indicator, but maybe also the education is bad. Maybe all of this plays into this, and a mining company doesn't want to invest in this country if there's social instability, right? Because then they are, or if there is not enough rule of law, because they are running in danger that they can't get workers, that they get nationalized because of the social unrests, or their mines get stolen, whatever. And these are risks we need to assess. So let's move on. Here is the global supply pressure index I made off of this, and this basically shows the supply stability out of a given country, right? Yeah, so we have GSPI equals, I don't have the name of the sign right now. I mean, I know what it means, but yeah. We have the MVI, that is the median voter, and I give that a score of -1, 0, or +1. So is it against mining? Is it, well, if they don't care about mining, or if they are for mining? And I do so also with the consensus score, because if the consensus rejects mines, but the median voter wants mines, then the median voter offsets the consensus, because of the long term they will get mines accepted, right? And I mean, this isn't exactly both aren't exactly a term that we can quantify very well. but I try to do so like this, right? Then we have the BC mine I. Why BC? Because before I thought business cycle would be good to put into this equation, but research shows that the business cycle doesn't have as much impact on the supply. So Claude came up with the mining sector cycle score, and I think this makes sense. As I said before, active mining expansion or just normal investments, no expansion approach, and this makes sense. And for the 5 stages, there are numbers -2, -1, 0, +1, +2. Yeah, this corresponds. For example, +2 is an active expansionary approach of the mines that they want to expand and so on. And -2 would be that they are in severe disruption in this country. Then GI is the value 10-year growth estimate, but rounded. And we have 1, 2, 3, 4, 5, but basically every number on the spectrum, of course, rounded. Because I think that if the consensus is bad, like it wouldn't make sense at all, because if the consensus is bad, then they wouldn't grow. But let's say consensus is bad, the median voter is bad, and the mining sector is bad, but the growth estimate is 10, then it would offset everything, because the factors speak for themselves. If the country is growing, they will eventually mine, right? And they will, expand basically. A WI here is the market share of the silver production in decimal. So we can put this into perspective with other countries, how stable the supply is. Yeah, so let's move on. How I put it into the perspective. But there's more. With rising silver prices, more people want a piece of the pie and start recycling old silver. As I said before, I wrote this on in the notes here, and so we will continue like this. Yeah, recycling. So recycling accounts for around 18.75% of yearly silver production, as I said here, and it is more elastic, but limited by the available amount of old silver, of course. And it's more elastic because recycling facilities are easier to build as mines. So mines, of course, need to find a geological place where silver is, or where copper is, where silver could be a byproduct, and this takes time. But with recycling it is different, and they just put up the facility and need to build up some supply routes, and then they have it basically. And so for recycling is dependent on the current price, and so I put this dependent from the price. And here we have the formula. We have supply recycling of P price, with the supply floor, so the structural minimum they could recycle. Then we have the S cap, so the physical maximum they can recycle. And I subtracted the S floor from the cap, because the S floor is also a part of what's already recycled, and we don't want to take this twice. We multiply this by 1 divided by 1 plus E high, E minus K, and P minus P mid in brackets. And K is the steepness parameter of the curve, anchored in historical price recycling correlation of price and recycling capacities. And P is the current silver price, and P mid is the price where half the recycling capacity gets activated, also based on historical points. Yeah, so this describes the recycling capacity we have at hand by the given price. And of course, it's only a model. If there's something to change, if there's, I don't know, if the funding rates are exceptionally high that they can't afford to build something like this, or anything exogenous factors that aren't included into the formula, because there are infinite amounts of things that could happen, and this only based on historical happening, right? Yeah, and then there's the silver supply, and that consists of S mine and S recycling. But now let's move on to the demand side, right? On solar, we have this simple scheme that you will probably think of first. So we have rising silver prices. This increases the cost for solar module. This decreases the demand, because people think, man, this too much, I won't buy this, basically. And then we have the silver deficit shrinking. Yeah, this is what you will think probably first, but let's say this: if the silver price increases or rises, companies just reduce the amount of silver per module. It gets replaced by copper partially, because they they must so to keep their profit margins. And also there's a new process that takes copper and makes it fit into the task that makes it capable for the task of silver, and is cheaper. But this is a thing we will probably see in 2 years or so. So if the silver price isn't rising astronomically, then this won't come before 2028 or so. Yeah, and here is a crucial condition that is important to keep projects and demand running. And this is basically that, I mean, this is complicated written down here. The thing here is only that the elasticity of the solar price, so the change in the solar price, cannot be higher than the elasticity of a budget of some institution, because firstly, most of demand is coming out of institutions like the EU that want to get green, and they aren't as sensitive to price. They are just saying, we want to achieve this goal, and these are political goals they want to achieve. This isn't because they are good people, but because it's just politics, right? They need to achieve this. But this doesn't mean that they will pay any price for this. So there's also budget elasticity written down in Bmax, that can't be overstepped, or projects stall, and the companies lose these projects and these tasks at hand. So although prices rise, they must stay below the maximum amount of budget, and so must the budget elasticity equal the price elasticity, like the budget elasticity equal or be more than the price elasticity, as I wrote down. Then we have here next the institutional and private demand, and that is the I inst equals I0, so the start of the observation, and G inst is the target they are trying to accomplish. Yeah, so this is basically how much electric capacity they are installing, and T is of course over time. And the formula below this is also E inst. I made a mistake there. This should say I private, also with time as a factor, and I made another mistake there. I'm sorry, I just copy and paste the first formula to be time efficient, but I forgot to add a parameter and to change the name to private. And the private demand formula is actually dependent on the time and the price of silver, because private people aren't just paying any price given. And so we have here the start of the observation with I private 0. Then we have the amount they want to install. And we have the price at the start of the observation divided by the given price right now. And this epsilon is the elasticity they have, or what they accept as price change to still buy, right? Because this determines how much they are buying after price increase, after price loss, after price decrease, and so on. So this is the demand. So here's the general demand formalized. We have the solar with price and time equals the institutional demand over time, multiplied by the substitution of silver. And so the institutional demand is a number of megawatts, and the CPT is a number of grams of silver per megawatt. So this multiplies, and then there will come out a product out of this whole formula of tons. And we could also potentially, with a constant K or something like that, calculate this into million OZ, right? And on the right side we have the private demand with PNT and also the gram silver per megawatt. And then we have the next demand driver, and that is the EV space. We have firstly there private cars, then we have the institutional fleet market, that is less sensitive to price, and we have the electric heavy-duty vehicles that have 4 times more silver than in a private car. And the institutional fleet market is also special because they have multi-year procurement cycles of 3 to 7 years. So they are buying a lot of cars over time, and so they represent more consistent demand. So the superior trend is, other than in the solar industry, where silver can relatively easy be reduced and soon be replaced, EVs and ICEs, so ICEs are internal combustion engines, and these are engines, and these are basically cars with gasoline or diesel or something. EVs and ICEs only get more complex with sensors and self-driving, driving the total silver demand up. Other materials don't have the capabilities silver has. And in the EV space, there are actually special capabilities, because cars need to be secure and they can't use any metal, because if there's one error with the steer-by-wire, then the car might end up crashing, and this can't happen at all. And so they need to be extremely cautious what they use as a material, and they can't use any material. And silver, let's say special electric capabilities, and these are needed in such cars, for example. And we can illustrate the silver demand, the total silver demand of EVs, in a formula that says the demand EV with price and T, and then we have the new cars. We have the new cars private over time, and new cars private with price and time in it, because also here still private consumers are more sensitive to the price of silver, and with that to the price of the EV. So this is a absolute number of cars, of new cars. Then here we have the amount of silver per car. Then here we have the institutional fleet demand, also with price, but they are less sensitive to any price changes. So the epsilon variable we also had in the other formulas is more elasticity for the price to move in. And also again the silver demand per car, and this is basically the same as in the private sector, because if we talk about fleets, then they most likely, like taxis or something like this, they most likely have similar cars to private cars. And we have the heavy duty vehicles right here, and these are basically only with the time in it, because they aren't as sensitive to prices. Yeah. Here is also K in it. As I said earlier, this is only a constant to calculate this into OZ, into ounces, into million ounces. And here FEV is the substitution process, so the replacement of silver. That isn't as fast as in solar, but it is still there, especially with increasing price, so it is still a topic. And ICE over time is basically the replacement of ICE cars over time. So here are the new EVs on the market. We have new cars, new private cars with price and time in it. And here we have the epsilon I told you about earlier. This is different to the fleet market because, as I said, institutional people are less sensitive to price as private consumers. And so here we have the cars at the beginning of the observation. Then we have the estimated, so on historical data, increase, so relative increase of cars per year. And here we have the formula to calculate the price impact. And we take the current price divided by the price 5 years ago, think so, to see how it developed. And here we also have, here is 80%, 18% per year. Here we have 15% per year. And here we have 45, and don't get let's say not blinded, but right now there's only a rather small amount of heavy duty vehicles, electric heavy duty vehicles, and so they are more scaling into it, and because of this there are more of them, right? And actually this doesn't have P in it. I'm very sorry for my mistakes. So let's continue. Silver use in EVs over time. Of course, here's a substitution I talked about earlier. These two are the same because, as I said, if they are buying a fleet for a taxi driver, then they most likely have a similar car to private cars and only have 35 grams per car, but heavy duty vehicles have more silver, and because of this they have another number at the start of the observation. Then here we have data centers, the last big demand driver we will be looking at. And first we have the standard data center that consumes about 15 to 20 kilograms per megawatt, and it's less sensitive to capital constraints because of long-term renting of these servers, and this is just less risk averse. But then we also have hyperscalers and AI. These are emerging industries, still emerging techs. This is emerging tech, and so they are more risky to investors, and so they are both sensitive to capital constraints, and they are representing a less reliable demand source. But in the same time, they consume higher amounts of silver because of the electric capability silver has. Yes, and I put this also into a model. We have the demand of data centers over time here, and here we see the time minus right. So data centers, they get planned and they get built, and so they don't need silver immediately, but of course in the building process this makes sense as they build up the energy infrastructure like transformators and this kind of stuff, and also like the backup system, so backup batteries and all the system around this. So I subtracted it from it, because if we say at the beginning of the observation at t equals 0, then there won't be silver actually used or needed. And so I subtracted the like gamma, I think this is gamma, I hope so. This would be embarrassing. Gamma standard, for example, here, because this is standard data center demand. And so I subtracted this. So the demand only occurs when it's actually needed. Right? So also every formula I showed you has a bit of lag in it. Because, for example, recycling also takes a bit of time until it's built. And I'm calculating this with the time at hand, and it's actually good for us as investors that it calculates the future, because we want to know what are the conditions in the future. And of course this is still a financial model. Any factor in the real world can completely destroy this, in the worst case, of course. But we want to know what's going on in the future and invest based on the future, because right now it's priced in, everything is priced in. But what happens in the future isn't. And so is this important, and because of this is right as it is. Then we have the demand of hyperscalers, and of course also multiplied by the silver intensity per server. So here it would be around 15 kilos or so, I said. Then here we have like 20, and here we have 40, and everything of this also multiplied by K, so we get it in million ounces. Then here are the megawatts per data center per year. Data center per year. And this is basically the amount of megawatts at the beginning of the observation, and here we have the growth rate per year, and this is the same in every formula, but here we have also the price sensitivity. And we will look at this now, because we have R here is R base divided by RT with lambda, and where RT is the current funding rate and R base the reference rate, lambda represents the capex elasticity, because again the price for a project like a new hyperscaler somewhere can't be more than the budget, right, and the budget elasticity. And so our funding rate's important, because they need to fund their project somehow. And the output is in percent, showing the increase or decrease of investment in reference to the R base funding rate. So this is also a thing that puts it into perspective, to see how it behaves in different environments versus the given environment. So what does it look like deployed? Yeah, we will skip this one. I'll show you next time. And this is it for now. I also want to talk about copper, but I didn't get it done. And I want to be completely honest about this. I didn't get it done in time, and I wanted to do this video right now. And I actually wanted to to make this video last week, in the end of last week on Sunday. But now I have it done, and we will talk about copper, of course. And it's basically the same as silver, but just with some other demand drivers. So for example, we have production in copper. And I also want to talk about energy, as you probably saw in the table of contents. Because energy is also important.